welcome to lesson 3 of the bond market series. Today's lesson, we're going to break down something that confuses a lot of new investors, and this is why bond prices changes. And on top of that, we're going to talk about what causes them to go up and down, even if the bond terms don't change. So this will kind of cover the core mechanics-ish of how bond prices works, how interest rates affect bond prices, and what premium and discount bonds actually mean. All right, let's get into it. So, one of the biggest misconceptions about bonds is that you're locked in until they mature, which is not true. Most bonds are traded on what's called the secondary market, kind of just like stocks. This means you can buy and sell bonds anytime after they're issued. This is often done through brokers or trading platforms. So if you bought a bond that matures in 10 years, you don't actually have to wait a full decade to get your money back. You can sell it tomorrow if you want, but the price you get might be very different from what you paid. That's because a bond's market value fluctuates consistently, like a stock. It is affected by interest rate changes, investor demand, and even the issuer's financial health. So for example, if interest rates go up, your bond's fixed interest becomes less appealing because a newer bond is receiving more interest over time and its market price drops therefore. On the other hand, if rates fall, your bond looks more attractive, so its price rises. So if you think about it, let's say I have the interest rates 1%, the interest rate's 3%, and on the bond and in the market, and then the market interest rate decreases. This means your bond is actually receiving more money than the actual market one would be. Therefore, your bond's now worth more money. On the other hand, if the market interest rate increases, your bond's interest rate's fixed. Therefore, it's receiving less, and a newer bond that has the new market interest rate will be making more. Therefore, your bond value decreases in value. And just like that with any market, supply and demand matter. If everyone wants low response during uncertain times, prices can go up regardless of what the original terms were. So when you see a bond trading for more than its original value, that's called trading at a premium. If it's going for less, it's trading at a discount. This doesn't affect the fixed coupon payments, but it does affect your yield, which we'll talk about in a few slides. So here's one of the most important principles in all of bond investing. Interest rates and bond prices move in opposite directions, which I kind of just mentioned, but I'm gonna go over it a little more simpler. So it may seem counterintuitive at first, but once you understand the logic, it makes perfect sense. So let's say you bought a bond that pays a 5% coupon. Now let's imagine that the interest rate in the market rises to 7%. Suddenly, new bonds are offering a better deal. Investors can earn more elsewhere. So what happens to your 5% bond? Well, it becomes less attractive, and the only way to sell in the market is to lower the price. So the buyer ends up with a similar return to what newer 7% bonds are offering. In this case, your bond will likely sell at a discount face value. On the other hand, if the interest rates drop to 3%, then your 5% bond is much more attractive. It now pays more than the market average. So investors are willing to pay more to get that fixed return. Your bond will now trade at a premium above face value. Now, the important thing to understand is that your bond's coupon never changes, but its price adjusts so that its effective return, called the yield, stays competitive with the current market conditions. And so this inverse relationship is what drives most of the day-to-day movement in bond prices, and it's why bonds can still be risky even if they seem safe on paper. So if you buy a low risk bond, it's not necessarily safe because of interest rates. And the safe is in quotations. Okay, so when bond price shifts, they either trade at a premium or a discount to the original face value. A premium bond means it's priced above its original face value because its coupon rate is higher than the current market rates. A discount bond is priced below face value because its coupon rate is lower than current market values. You still receive the same fixed payments, but the price you pay upfront is different depending on a market demand and ongoing rate. I already mentioned this. I know you guys know this, but I had to make it a slide for it. Let's make another scenario, a quick example, just so you could grasp this idea. Let's say you buy a bond for $1,000 that pays 5%. That's $50 per year. But next year, interest rates rise and new bonds are paying 7% or $7 per year. Now I'm adding this price of how much you're making just so you can understand this. So right now, 5%, I'm making $50 a year for my bond. But let's say if I were to buy a bond next year with the 7%, because the new market interest is 7%, well, I could be making $70. So I'm making 50, as of right now with my bond, I'm making $50 each year. But let's say a year from now, I'm still making that $50 a year, but people with the newer bond are making $70 a year. If someone can earn $70 on a new bond, why would they pay $1,000 for my $50 bond? Well, not $50 bond, but my $1,000 bond that pays $50. They wouldn't. Your bond would only sell if the price drops. So let's say my $1,000 bond, I could sell it for roughly, I don't know, $880. So that $50 interest equals the same effective yield as the newer bond. So since I'm selling it for a lower price, over time, even though I'm getting 5% interest, the person, it ends up balancing out in a way, basically. So this is how bonds are priced in the market. Obviously, it's more accurate than just $880. It's more to the decimal. So yeah, but not changing the coupon, but by charging the price. So this is how they're priced. The bonds are priced. So let's quickly clear up one of the most misunderstood parts of bond investing, which is called the yield. People often confuse coupon rate with yield, but they're actually not the same thing. So a coupon rate, that's the fixed interest rate set to the bond is issued. So when the bond is issued, that is the coupon rate. So if you buy a $1,000 bond with a 5% coupon, you'll receive $50 per year no matter what happens in the market. That doesn't change. The coupon rate doesn't change. But in the real world, bond prices move up and down. So investors need a way to calculate what they'll actually earn based on what they pay for the bond right now, not just the original terms. This is where yield comes in. So the current yield is the annual coupon divided by the bond's current market price. Let me repeat that. Current yield is the annual coupon divided by the bond's current market price. So if you have a $1,000 bond that is now trading at $950 and it still has a $50 coupon, the current yield is 50 over 950 multiplied by 100, which is roughly 5.26%. And it gives you a snapshot of how much income you'll earn relative to what you paid. Now, yield to maturity, this is a more accurate way to measure your total return. Yield to maturity, or sometimes just is called YTM. Nobody says YTM, but like symbol-wise, like just with letters, YTM. YTM, I'm just gonna say, so yield to maturity tells you the true annualized return you'll get if you hold that bond until it matures. It includes all coupon payments plus any gain or loss from buying the bond at a discount or premium. So if you buy a bond for $950, let's say, and you get back $1,000 at maturity, that $50 capital gain is factored in along with the interest payments to calculate your total return per year. Your yield to maturity is what most professionals look at when comparing bonds, especially when the bond price is different from its face value. So kind of like the bottom line, the coupon tells you what the bond pays, the current yield tells you what you're earning right now, and the yield to maturity tells you what you'll earn over the lifetime of the bond. And so I guess kind of knowing how these yields work will help you compare bonds with different prices, terms, and risk levels so you can make smarter decisions and avoid surprises. Another thing quickly I want to talk about is bond rating and price movements. So bond ratings are a major factor in how bond prices move because they tell investors how likely the issuer is to repay its debt. These ratings are assigned by agencies like Moody's, the S&P, and Fitch, and they range from an triple A, which is the safest, to down to D, which is default. Default, you lose money, default, bankrupt. So bonds rated AAA to BBB are considered investment grade. They're lower risk and typically issued by stable governments or corporations. These could be Apple, Microsoft, big companies, or governments. Anything rated BB or lower is called a high yield or junk. In this case, we have all the way to BBB minus, and then BBB plus lower is called junk. So this meaning it carries higher risk but offers higher returns. So the key is when a bond rating is downgraded, its price usually falls because investors see it as a risk, and many large institutions are required to sell non-investment grade bonds. On the other hand, a rating upgrade can increase demand and cause prices to rise. So credit ratings don't just measure risk, they directly influence how bonds trade in the market. So this rating is not just, oh, I want to buy this because it's a higher rating. No, it also reflects on the value of the bond, which is what this lesson was about. this is pretty much it on this lesson. Next lesson, we're going to talk about how to invest in bonds, when and why. That video will probably be the last one in this series. There might be another one that I'm thinking about doing, but I'm not really sure if it's really important, but we'll see. I'll see you guys in the next video. Thank you so much.